Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated. And wow, what markets, Miles. I mean, we talk about fundamentals moving the technicals, and your technicals are all over the place because a lot of fundamentals just shifted in a short period of time, namely the Federal Reserve. So the reason we record on Wednesday afternoons is so we can capture those FOMC minutes in a sense, because they really can impact the markets greatly. And in short, we'll get into the details of what they discussed, but we've had a $40 jump in gold. We've had a dollar plus rise in silver, up over 3.5%. 10-year treasuries are down. The U.S. dollar index took a black eye, dropping below 103. So that's a lot of price action, and we've been whipsawing here the last number of weeks on the metals prices. So let's start with you and get some gold chart going.
I don't know what you're talking about, Tori. My technicals are not all over the place. They're exactly where they're supposed to be. The problem here is the fundamentals.
It's the pace at which your technicals are achieved.
Because my technicals did not make a Fed announcement today. Your fundamentals did. And talk about changing horses midstream.
That's right. I'm surprised, honestly, to say that as we look at this gold chart. Looking at last week's spike, I mean, you did such a great show last week on that all-time high, and then coming down to your predicted lows, very close. I mean, we bottomed around 1,970, and we're hoping for just maybe $10 more to make your chart perfect. But lo and behold, the Fed came out today, and Powell just kind of pivoted, didn't he? You sound a little disappointed in him.
I am. I'm disappointed. He's been holding so strong. I've been so proud of him. And the federal government hasn't been playing ball because he's been raising interest rates and they've just been increasing spending. So it hasn't helped him much, but he's been slowly chipping away at the Fed balance sheet. They've been raising interest rates. The only piece we were missing was government spending, which was rampantly out of control. Well, that's going to get a little bit easier for them because we're now looking at 3 potential rate cuts next year. Because everything's fine and dandy.
Yeah, that is the big news. It's those rate cuts. You know, for now, they're saying that it's necessary to just maintain the federal funds rate in that target range of 5.25% to 5.5%. So they didn't actually cut. They say that they intend to 3 times in 2024, but I think what the markets also liked is that they also mentioned expected cuts in 2025 and 2026. But what I'm confused about here is what has changed. This dovish activity by the Fed really is not indicative of what they had said before, nor indicated by what they had set as targets. So they made 4 points. 1, the growth of the economic activity has slowed. So it's still growing, but it's growing at a slower pace. 2, job gains have moderated, but they remain strong. So the job gains are still there. 3, the unemployment rate has remained low. That's not what they wanted. They wanted the unemployment rate increasing. They were trying to cut 2 million jobs net. And then finally, inflation has eased but remains elevated. So inflation's still elevated. It has slowed in its climbing, but they actually also came out and said that they expect it to increase from here. So none of those 4 really are any rosier than what they were at the last FOMC, which, to your point, Miles, you're saying, okay, the federal government's not cooperating. To me, the federal government is doing some powerful persuading here because I don't see any other way that you can sit there and predict a rate cut when nothing substantial has changed.
No, I think there's a couple arguments you could make here. Giving the benefit of the doubt, they are going to see if they can start to plane things out a little bit. Or giving the benefit of, say, next year being an election year, they may be trying to stimulate the markets in a certain direction to give people the feel goods. I'm just not sure.
Yeah.
You know, I'd love to give the benefit of the doubt and say, okay, we've made some progress. We're starting to stabilize things because they are starting to stabilize things a little bit, at least as far as starting new trends of higher interest rates on average than 0, because 0 is obviously unsustainable. But 15 is also unsustainable. So maybe they're trying to say, hey, instead of going all the way up to 12 or 15 or 20, maybe we can start to stabilize out in a 5 to 7 range, which is much more reasonable long term. But then it just chews on me that next year's an election year. It just feels
Right.
too convenient.
Yeah, life's just gotten too expensive. And it's one thing when life gets more expensive, it's another when it gets more expensive to borrow also. So we've seen a maxing out of credit lines, credit cards, things of that nature. We've seen a slowdown in loans, both mortgage and auto. So that stifles economic activity, which plays into their objective. However, it becomes very socially and politically sensitive and something that becomes really a reason to vote one way or another. And remember those famous words, it's about the economy, stupid, right? So when it's about the economy, people vote with their pocketbook, regardless of their party affiliation. So that's where you're kind of leaning, is that, man, this just kind of reeks of political survivability in some instances. But who knows? Let's give benefit of the doubt. And in the meantime, what a fun breakdown here chart-wise. Where do you see us topping out? Is this an outlier event that you think we just continue back down and ultimately hit your technical level? Or is this the resumption of that climb from the chart that you put up 2 weeks ago, showing kind of that all-time high, a retracement back down, and then getting new legs to hit a new all-time high?
Personally, I just thought 1940 to 1950, somewhere in that range, would just look really good from a charting perspective. The 1970s to 80s still looks pretty good. It looks very good on the short term, because you're talking about, in the short term, coming back about a 50% retracement back from where this started back in October. October 1820, December 2140 and change. So 2 steps forward, 1 step back, and then obviously a big bump up today. So coming up from that 50% line, we're right at the 382 fib. So it took a nice little jump today. We'd really need to get probably another 10 or 20 bucks run out of this to start arguing, okay, we're actually going to go back up and test the old highs again.
Okay.
So could this be reactionary just based on the news today? Well, obviously, you don't go up 50 bucks in gold in 5 minutes because it's not reactionary like it has to be. The question is, does it have legs going forward?
Yeah.
I think gold is on the way up. Like I do say, has it sped up the time in which it's going to take for us to start making that step forward? I'd still like to see 1940, 1945, just because I like when charts end up making sense, but it doesn't have to. We could see gold push up from here. I'd bet against it. I actually do think we're going to see us come back down a little bit. I think this is reactionary, and I think those of you that have been dollar costing in as price has been going down, I think you're going to continue to get the opportunity to do so. But the whole point of dollar costing in is so that you continue to buy when it's going up, not just hope when it goes down. So for those of you that are consistent gold buyers, this is okay because you've been buying on average regularly for a period of time. So I wouldn't worry too much about outlier days like today. Maybe you just sit on the sidelines and see where we land come Friday or Monday.
Yeah, I totally agree. And silver did follow suit. In fact, not only did silver follow suit, it actually outpaced gold today. So up 3.5% compared to gold's 2%. The ratio came down about 1.5% as well. We were firmly at 87 to 1. Now we're 85 to 1. So that's good. I mean, I would like nothing more than that gold to silver ratio to shrink down back into the 50s. That's where our portfolios get really exciting and we get some significant gains regardless of what the spot price is doing. It doesn't have to be at all-time highs. They just have to have changed relative to each other that much. So all guys in my office are on that, and we'll see what happens. But that silver chart, man, what a swing. Do you feel like that support level was of any significance? And what do you see us doing on the upside there?
Well, sure. Silver was parked at the 618 fib for a couple days. So silver was waiting to see what was going to happen with the Fed announcement this week, as it's just sort of been sitting at 22 3/4, let's say. Big jump today, like you mentioned, 2270 to almost 24.
Yeah.
Couple dollar jump in silver, 10% move 8% move in silver in a single day. I'd like to see silver's got to get above 24. We can make a nice little rising head and shoulders pattern here, or at least break above the mid-November highs, not the beginning of December high. So you'll see on the chart here a little head and shoulders we could make in silver. But you'd have to get above that to start arguing on the upswing. But silver, unlike gold, gold has still yet come down to its 200-day moving average. Silver pushed below it. It's back above it. Silver could look pretty strong here. And there's a bottom trend line going back to like September, October that we just bounced along with the 618. So if gold's going to continue up, silver obviously is going to play catch up to some extent. I don't know if we're going to get the ratio back down into the 40s and 50s on this particular move if we keep going up. But you start letting silver play catch up a little bit, you might see it down in the 70s, and then you start getting ready to pull the trigger, so to speak, when we do have that ratio realigned back to something a little more reasonable.
Well, we all have to keep in mind, too, that these types of actions, the whole reason that they went to a zero interest rate policy or near zero was to stimulate the economy. So this is very economically stimulating. And they thought that the economy was too hot before, which is why they were trying to cool it down. So this is going to have a stimulating effect. We've talked a lot on this show about what the Federal Reserve balance sheet is going to do, and that's going to be another thing to watch. But if this is economically stimulating, remember, we're still a credit and leverage-driven type of an economy. As credit loosens and borrowing cheapens and people start to spend again, then that will be stimulating. And then with the leverage, obviously, that's going to have the same thing. With the U.S. dollar index dropping, that also raises the price of everything. So the lower the dollar on that dollar index, everything adjusts accordingly, even equities. So we've seen the dollar index come down now below 103 on this hit, almost 3/4 of a point, a little more than 3/4 of a point. But what are the equities doing? And is that going to tell you anything differently, or could all of this just be a short-term little blip, talking about the dollar and the equities?
Well, come on. You talk about them wanting to raise interest rates to slow down an overheating economy. Well, why in the world are they now going to lower interest rates? Just the announcement of it pushed the Dow up into almost all-time high numbers. We're right back up at the top to begin with yesterday. Like the price difference in the Dow between yesterday and today isn't actually that much when you look at the charts. So I don't buy that at all. I think it gets back to the political argument for the interest rate move, personally.
Okay.
So, yeah, the Dow looks strong. The Dow looked strong yesterday.
Well, it did, but we did get a 500-point drop. That's a vote of confidence in what Powell has said and done. The markets are going to love it. To me, that's actually more encouraging. As the ratio started to climb, that gold to silver ratio, it was kind of an indication that silver wasn't acting like the money metal, and it was sort of more of the economic barometer, that if things continue to stagnate or depress or recess, that silver was going to remain restricted in its climb. Well, if the economy's hot, that's different. Silver and platinum, and palladium for that matter, need a hot economy. The perfect storm for those white metals is a really hot economy with really high inflation. And if that can be sustained for a period of time, they'll take off and run. And so maybe this is a precursor to that, whereas before I kind of felt like, man, maybe the ratio isn't going to shrink and it's going to climb from here. So we'll see. Again, economically stimulating, that can help the white metals. It's why you see a ratio tightening today. Anything to mention on the platinum or palladium fronts as far as what you're seeing chart-wise?
Yeah, shockingly, or maybe not shockingly, platinum didn't move much today as a response. Platinum doesn't tend to respond to political moves unless it's Russian political moves. Palladium, same. Palladium continues to trickle down, still sitting right at or just under 1,000.
Yeah, the last I saw platinum 948. That's not terrible. At least we're in positive territory now, but what did we get down? 918 or something like that? I'll take a $30 move in platinum any day with our minority position in the accounts, but it doesn't mean anything yet.
Sure. Well, we went sub 900 just a month ago.
Yeah, that sub 900 was a welcome opportunity, but again, you talk about if you stretch out far enough, a relatively flat chart, not a whole lot of volatility there, but palladium's a different story. We've talked about it coming down to meet platinum. It hasn't quite happened. We've gotten very, very close. But in time, It will.
Right. I mean, platinum's been give or take $100 north or south of 1,000 for like 7-8 years now. Palladium, like you said, has been a very different story, north or south of like 300% above or below 1,000. So yeah, the volatility between the two, I think, is going to continue to tell that story. And just like gold and silver, more volatile with platinum and palladium, it deserves a piece of the conversation, but certainly not the whole pie when it comes to investing and adding things like platinum to a metals portfolio.
There you go. Well, and I also mentioned earlier, one of the primary headwinds with the metals is the treasury yields, and those treasury yields have also come down. The 10-year just about under 4%, whereas we had broached 5% at one point. So as that 10-year treasury yield has come down, so has gold gone up. And that's another bullish indicator that we can get some restraints off of the metals. Again, picturing this as a tug of war. You've got inflation, you've got debt, deficit spending, you've got treasury yields, you've got market uncertainty, you've got geopolitical tensions, you've got the U.S. dollar index strength, the equities market strength, Fed policy, Federal Reserve balance sheet, monetary policy, namely money supply. All of those things go into the push and pull of the metals, but it's also why over our lifetime gold tends to just go up. So with the Federal Reserve leaving things alone for now, the markets are loving it. So keep in mind, they haven't cut rates. They just are talking about leaving it alone, and they've penciled in those cuts, which I think is telling the markets, most importantly, that there are no more rate hikes foreseen in the near or intermediate future. So strong takeaways for the metals markets today.
Yeah, absolutely. Strong takeaways across the board. People like free money. I think that probably goes without saying. People like free money, especially Wall Street, big fans of free money, and going to get a little bit of extra free money next year. So we'll see whose hands it makes it into over the next 12 or 18 months, because I think somebody's going to cash out during election year 2024. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, you can find more info on our website at McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to speak with one of the advisors here at McIlvaney Precious Metals, we can be reached at 800-525-9556. Appreciate it and look forward to speaking with you soon. Take care.